Hi there, I'm Renos Vakis, lead economist at the World Bank, and your host for Accelerating Development Ideas for Impact. This is not your typical podcast. It's an AI powered conversation brought to you by the World Bank Institute for Economic Development, where we unpack the latest research with one goal in mind, turning big ideas into real world impact. Let's get started.
Thank you for the introduction, Renos. We all agree energy prices matter, but the real story here in the latest Commodity Markets Outlook report is how to turn that knowledge into something that works for development.
Indeed, and the global oil market is at a fascinating turning point. We're about to enter a period of significant, and I mean significant, oversupply.
Okay, so what does that mean for prices? Are we talking about a small dip?
It's more than a small dip. The forecast shows Brent crude oil prices declining from an average of $81 a barrel in 2024 down to 68 in 2025 and then $60 in 2026.
$60. Wow, that's a substantial drop. Is the evidence for this oversupply strong?
It is very strong. By the third quarter of 2025, the estimated excess supply is 2.7 million barrels per day. To put that in perspective, a surplus that large has only been seen twice before, during the 2020 pandemic and the 1998 oil crisis.
Okay, so this is a major market event. I'm guessing it's not just one thing causing it.
You are correct. It is a story of both supply and demand. On the demand side, growth is sluggish. The demand in 2026 is projected to be driven by continued excess supply, very weak demand growth in China, and the continued rapid adoption of electric and hybrid vehicles globally.
Ah, that connects the dots for me. China's economy and the EV transition are two huge global trends really making an impact here.
Precisely. And at the same time, supply is surging. We are seeing increasing production from 8 OPEC Plus members and continued strong gains in non OPEC countries, which have contributed to falling oil prices in 2025. Global oil supply is projected to hit a new all time high in 2025.
So you have slowing demand meeting record high supply. Here's the part that really interests me. What does this mean for policymakers, especially in countries that have to import all their oil?
And this is the turning point. For those oil importing countries, lower prices create space. They create real policy opportunity
Space for what exactly?
for reallocating public money. This is an opportunity to reduce fuel subsidies, which are often inefficient. That spending can be shifted to more targeted cash transfers or to growth enhancing investments in things like health, education, and climate related priorities.
So, in practice, a government could use the savings from cheaper fuel to, say, build a new hospital or invest in solar energy infrastructure.
That is exactly it. It also helps with the bigger picture. The forecast suggests these lower energy prices will continue to support global disinflation, which is welcome news for everyone.
You know, whenever prices get this volatile, up or down, the conversation always seems to turn to, well, control. Why not just try to manage the prices directly?
Yes, that idea has come up again recently with all the geopolitical tensions and supply chain disruptions. There is a renewed interest in what are called international commodity agreements, or ICAs.
So, groups of countries getting together to manage supply and stabilize prices. Has that been tried before?
It has. And this is where the historical experience offers a very important lesson. The record of these agreements is poor.
A poor record? Tell me more.
Most of the agreements for commodities, which have targeted coffee, sugar, rubber, and tin, have ultimately collapsed. And in many cases, their collapse actually intensified price volatility instead of calming it.
That's the opposite of what they were trying to do. Why did they fail?
A contradiction of commodity agreements is that when they have spurred higher prices, the higher prices encourage production from countries that were not part of the deal. At the same time, consumers start looking for substitutes.
So they created the exact conditions for their own failure.
Exactly. Take coffee. The International Coffee Agreement was undermined by the rise of Vietnam as a major exporter that was not a member. With tin, higher prices led to new producers entering the market, and people just started using other metals like aluminium.
Okay, but what about the big one? Most people assume OPEC has been really successful at managing oil prices.
It is the most enduring agreement, certainly, but it has consistently faced these same challenges. When prices were high in the 1970s, it spurred the development of new non OPEC supply from places like Alaska and the North Sea.
And I remember the price boom in the 2000s.
And that encouraged the expansion of US shale oil, Canadian oil sands, and biofuels. The market always adapts.
So the producers adapt. What about the consumers? Do they just pay the higher prices?
No, they also organized. Major consumer countries formed the International Energy Agency, the IEA, back in 1974. They coordinated their responses, built up emergency reserves, and worked to reduce their dependence on imported oil.
So they diversified their energy sources.
They did, and the effect was profound. Oil's share of total energy consumption fell from nearly 50% in the early 1970s to about 30% by 2020. The market response from both producers and consumers is a powerful force.
So here's the tricky part policymakers face today. If these big coordinated price management schemes have a poor record, what's the alternative?
The historical record points toward a more resilient approach. While temporary interventions during an acute crisis can be effective, sustained price management has not worked.
So, what does a more resilient policy look like?
It focuses on fostering diversification of production and consumption. It means investing in technology and innovation, encouraging data transparency, and relying on market based pricing mechanisms.
So, it's less about controlling the market and more about making the market work better and making your own economy more flexible.
That is the lesson. These measures offer more durable protection against commodity price volatility than attempts to control prices and markets directly. When we step back, two clear paths emerge for policymakers. First, the coming drop in oil prices is not just a market forecast, it is a window of opportunity for oil importing nations to build stronger, more sustainable economies. And second, the lessons of history are unambiguous. Resilience comes from adaptation and diversification, not from attempts to control volatile markets directly. Fostering innovation and market transparency is the more durable way forward.
Now, over to you, Reynos.
Thank you for joining us. You can find the full report on our website. Just follow the link in the description. Be sure to subscribe to be the first to know about upcoming episodes. And before you go, how do you plan to put what you learn into practice? And what topics you'd like us to explore next? We'd love to know. Until then, goodbye.